Well, hello Dragons, and welcome to this instructional video for Lesson 4, Part 3, Making Production Decisions. The main idea behind this economics lesson is production decisions are affected by the need to maximize productivity and by the costs of production. With that in mind, by the end of watching this video, you'll be able to explain why producers look at productivity when making supply decisions, describe how varying levels of input affects the level of output, and explain how changes in production costs affect producers' supply decisions. Now that the outcomes for this lesson have been shared with you, let's get ready to rumble! You make production decisions every day. For example, you decide how to complete or produce your homework assignments. You decide how to make your lunch. You decide how to make decorations for a school dance. Although you are probably unaware of it, when you make these types of daily choices, you go through a decision-making process much like the one that manufacturers use every day. How do you and other suppliers make production decisions? You already know part of the answer. As noted in this lesson and in Lesson 3, the amount of goods produced is influenced by the law of demand and supply, elasticity of demand and supply, and shifts in the demand and supply curves. There are two pieces of the puzzle left to examine, however. Production levels also are influenced by productivity and the costs of production. Manufacturers must consider these two factors before deciding how much to produce for the market. As noted in Lesson 1, productivity is the amount of goods and services produced per unit of input. In other words, productivity tells business owners how efficiently their resources are being used in production. Think about your own productivity regarding homework. Imagine that you have a test tomorrow in one of your classes. You estimate that it will take you about 3 hours to study for it. That is, for every 3 hours of input, or study time, you produce 1 unit of output, a good grade on a test. Can you be more productive? Perhaps by studying with a friend, discussing the material and quizzing each other, you can increase the effectiveness of your study time. This type of studying allows you to produce a good grade on the test with only 2 hours of input instead of 3. Of course, productivity in businesses is much more complex and involves more inputs than the above example. But like you, business owners must examine their productivity in order to maximize efficiency and profits. And like you, they must consider varying the amount of their inputs in order to increase productivity. To do this, business owners look at their total product, marginal product, and how the two figures change as inputs change. To understand how output is affected by changes in input, a company first must calculate its output. All of the product a company makes in a given period of time with a given amount of input is called its total product, or total output. This table contains a production schedule for the Golden Duck Company. The second column of the table lists the possible total product levels for the company. Golden can make anywhere between 0 and 1,000 rubber ducks a day, as it uses 0 to 13 units of labor. To maximize productivity, business owners also need to know their marginal product. Marginal product is the change in output generated by adding 1 more unit of input. How do businesses calculate marginal product? Let's return to the production schedule. The new third column lists the marginal product for each level of production. That is, it shows how many additional units, or ducks, are produced at each level of input. For example, if labor input increases from 0 to 1, the marginal product is 10, because 10 ducks are produced. If the level of input rises again to 2, the marginal product is 40, because 40 more ducks are produced than before the increase, or 50 minus 10. Once total and marginal product have been calculated, a company is ready to vary one of its inputs to see the effect on output. This effect is governed by a basic economic principle, the law of diminishing returns. The law describes the effect that varying the level of an input has on total and marginal product. It states that as more of one input is added to a fixed supply of other resources, productivity increases up to a point. At some point, however, the marginal product will diminish. Eventually, it will result in negative marginal product. Keep in mind that this principle applies to situations in which only one input is varied. Of course, a company like Golden would want to vary several of its inputs to find the most efficient combination. It might increase the number of its workers and add more machines to its factory. Varying several inputs at once, however, makes it difficult to determine clear cause and effect results. If production does not increase at the Golden plant, was it a result of hiring more workers, adding new machines, or both? By looking at only one input at a time, the effect on total output is clearer. The three stages of production that can be predicted by the law of diminishing returns are called increasing marginal returns, diminishing marginal returns, and negative marginal returns. The effect on output of varying levels of input can be seen by looking closely at these three stages. Increasing marginal returns is the increase in both total product and marginal product as input levels are increased. Look at the production schedule. The first column shows one input in making rubber ducks, labor. As this input varies, so do the output levels of the company. Clearly, if there were no workers, no product is made. With one worker, the company makes 10 ducks a day. As the number of workers increases to 13, total product levels continue to increase. Extra workers allow each person to specialize or concentrate on a particular part of the process. This increases production. Notice how the marginal product in column 3 also continues to increase with the addition of the first 11 workers. As each of these first 11 workers are added, output rises at a faster rate. The first worker boosts production by 10 units, the second by 40, the third by 60, and so on until the 11th worker, who raises output by 200 units. You can also see this rise in production in the production curve. The vertical axis on the graph shows Golden's total product or output. The one varying input, labor, appears on the horizontal axis. As the number of workers increases from 0 to 11, the total output rises at a steep rate. Diminishing marginal returns is an increase in total product with a decrease in marginal product as input levels are increased. As the law of diminishing returns predicts, however, at some point output begins to increase at a diminished or lower rate. The 12th worker only adds 110 units, whereas the 11th worker added 200 units. Perhaps there is not enough machinery in the factory to keep the 12th worker fully employed. Thus, even though total product continues to increase with the 12th worker, marginal product begins to decrease. That is, total output increases at a slower rate than it did with workers 1 through 11. The production curve reflects this drop in the rate of increased production. As the number of workers increases from 11 to 12, the rise in total output begins to level off. Production with these workers is not rising as fast as the first part of the graph. Negative marginal returns is the decrease in total product with negative marginal product as input levels are increased. The 14th, 15th, and 16th workers make the situation even worse. At this point, workers are getting in each other's way, creating bottlenecks on the assembly line and actually lowering the level of output. In addition, the overcrowding results in frustrated workers and low morale, which further erodes productivity. The 14th worker, for example, lowers production by 25 units. You can see this drop in total product in the production curve. The graph curves downward after the addition of the 14th, 15th, and 16th workers. This reflects the negative marginal returns to labor. Production schedules and curves help business people apply the law of diminishing returns to their production decisions. By discovering the point at which their inputs are most efficiently used, they can set production levels that will maximize profits. Manufacturers must also look at their costs of production when deciding how much to supply to the market. As noted in Part 1, a business's cost of production includes any goods and services used to make a product. Manufacturers are particularly interested in their costs of production because these costs directly affect the amount of profit their business makes. For example, imagine that you start your own lawn mowing service. 2 of your customers want to have their lawns mowed by 10 a.m. Saturday morning. They are willing to pay you the same amount of money, $15. One lawn takes 1 hour to mow, and the other takes 2. You know that you only have time to complete one of the assignments by the deadline. How do you choose? For a cost of 2 hours' work, you have the potential to earn $15. You can earn the same amount of money by working for 1 hour on a different lawn. But your cost in earning that money is lower, 1 hour of work instead of 2. In search of the highest profit with the lowest cost, you decide that on Saturday morning you will mow the lawn that takes 1 hour to complete. Manufacturers and other suppliers deal with complicated production costs and must consider many factors. To make analyzing costs easier, most producers divide them into several categories: fixed, variable, total, and marginal. Analyzing these various production costs helps producers determine production goals and potential profits. Some production costs do not change no matter how many goods are made. For example, whether the Golden Duck factory produces 10 ducks a day or 1,000, or even if it produces none, the rent that the factory pays stays the same. Production costs that do not change as the level of output changes are called fixed costs. Fixed costs include rent, interest on loans, property insurance premiums, local and state property taxes, and salaries. Fixed costs also include routine wear and tear on machines and other capital goods. In the Golden Duck factory, for example, the machine that molds the toys was purchased 5 years ago. Each year, a portion of the value of that machine has been considered a fixed cost. Why? Each year, the molding machine is older and less efficient. The older it becomes, the less value it has. This aging of the machine and other capital goods is thus seen as a cost. Businesses do not determine the amount of depreciation or lessening in value on each and every capital good they own, because these calculations would take too much time. Instead, tax laws and standard accounting practices allow them to divide the cost of a capital good over the life of the good. You can see the total weekly fixed costs for the Golden Duck Company. The first 3 columns are the production schedule from an earlier slide. Column 4 shows the fixed costs for each level of production. Notice that the fixed costs listed in this column do not change even though the production level changes. Whether the company produces 0 ducks or 1,000 ducks a day, the company's total fixed costs, also called overhead, remain $3,400. Unlike fixed costs, variable costs change as the level of output changes. Variable costs include raw materials and wages. In the case of the rubber duck factory, for example, as production rises from 10 to 1,000 ducks a day, the number of workers also rises. The wages of these workers are an added or variable cost. So are the added materials used to make the additional 990 ducks. You can see Golden's variable costs. Column 5 shows the total variable cost of making ducks at each production level. As you would expect, the variable costs listed in column 5 change as production levels change. When no ducks are made, for example, variable costs are $0. At the production level of 1,000 ducks a day, variable costs are $2,795. The sum of the fixed and variable production costs is a company's total costs. At zero output, a firm's total costs are equal to its fixed costs. If a company is not producing anything, it does not have any variable costs, no workers to be paid, and no raw materials to be bought. Thus, its fixed costs are its total costs. As soon as production begins, however, so do a company's variable costs. This in turn raises the company's total costs. At a production level of 1,000 ducks a day, what are Golden's total costs per week? Adding the company's fixed costs, $3,400, and variable costs, $2,795, at this production level reveals weekly total costs of $6,195. To make production decisions, business people need to know not only their company's total costs, but also the marginal costs for the company. Marginal costs are the additional costs of producing one more unit of output. How do business people determine marginal costs? As you know, fixed costs do not change as production levels change. Therefore, to determine marginal costs as production levels change, a business must look at its variable costs alone. If Golden wants to increase production from 875 to 1,000 ducks a day, its variable costs increase by $430, from $2,365 to $2,795. The marginal cost of making each new duck is the additional cost, $430, divided by the number of additional ducks, 125. So $430 divided by 125 is $3.44. This figure means that each additional duck, numbers 876 to 1,000, cost $3.44 to make. If Golden wants to increase production from 875 to 999 ducks instead of 1,000, it can calculate how much this will cost. 124 additional ducks at a marginal cost of $3.44 equals $426.56. This allows business people to calculate their exact cost of any change in production levels. Many business people do indeed make marginal production decisions to produce a few more or a few less units of output. Marginal costs allow the business to determine the profitability of increasing or decreasing production by a few units. So that's the way it is with Lesson 4, Part 3, Making Production Decisions. At this point, you should know that when setting production levels, business owners must consider total product, marginal product, and the law of diminishing returns. And making production decisions requires business owners to determine their fixed costs, variable costs, total costs, and marginal costs. Don't forget to subscribe to my channel to have the entire catalog of economics videos available at your fingertips. Click the subscribe button and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons. See ya!